So let's talk real quick about indicators versus price action. And this is an argument that I have with a lot of my friends. I've got a good friend who's a CTA in Dallas, Fort Worth actually. And he's a systems guy. He's all about systems, building systems and testing systems and back testing systems and statistics and so he's big on indicators. And that's fine, it works for him, right? So but when price action traders, support and resistance traders were more of a discretionary group. And so when you look at indicators versus price action, in my opinion, one leads the other, and I'd rather be in tune with the one that's leading the other. So price influences indicators. Everybody knows that there's leading indicators, there's lagging indicators, and there's, you get conflicts between them. A lot of traders fall into the trap of searching for the holy grail of indicators. If I tweak this one just a little bit, or if I add this indicator to my chart, what's the word for it? The word escapes me right now. There's a tune, right? If I tune my system, whatever, if I can just eliminate this one loss, maybe my system will perform better. And it really ends up being a complete waste of time. So, for a lot of people. So, don't search for the holy grail. There is none. There is no holy grail in trading. If there's anything close to a holy grail in trading, it would be risk management, in my opinion, right? So, thank you. Optimize. That's the word I was looking for. More indicators will not increase your accuracy. There's a lot of traders who try to apply one indicator that has a statistical probability of, say, 30% and another one that has 40%, and they think they end up with 70% accuracy. It's just not the case. Right? Statistics don't work that way. So, and then finally, indicators themselves are not self-fulfilling prophecies. Okay, I hear this all the time and it bugs me. If you show me 100 traders, I can show you 100 different ways to trade the CCI indicator. The bottom line is that, all the books talk about indicators, a lot of websites talk about indicators, and the assumption is that, well, if we're all using them the same way, then indicators, become a self-fulfilling prophecy, whether it's Fibonacci or, moving averages, whatever. And what's interesting about this is that most of the time when I see a quote-unquote indicator-based trade, if you look closely at the price action, the indicator is simply reflecting what price action did at a support and resistance level. And so let's look at that for a moment. So here I have a 4-hour chart, New Zealand dollar, US dollar 4-hour chart. And if you look closely at the CCI indicator, you've got overbought, and oversold. And the way these are typically taught is, if the indicator moves into the overbought, moves out, then, it's the sell signal, right? Or the other way around, moves into oversold, moves out oversold, you've got a buy signal. So if you look closely at the two signals that, could have potentially given you a winning trade using CCI, what you see on the chart is that price just simply moved into supply levels or demand levels, right? So resistance levels or support levels, and moved out just as it would any other support resistance level, right? So the advantage of price action over indicators, in my opinion, is that it will put you in the market in tune right at the right supply and demand level with a little practice. You can see a potential price action entry versus where the CCI entry actually occurred. Okay. So that, anyway, that's my spiel on indicators versus price action. And this is why, I might use an indicator to point me in the right direction, but ultimately price action is going to lead the way for any trade decisions that I make.